Most Americans are about to do something with their tax refund that costs them money. And I'm not saying that to be harsh. I'm saying it because the numbers are right there. The personal savings rate is sitting around 4.5%, and roughly 60% of households still can't cover a $1,000 emergency without a credit card. Here's the part that matters. A new tax law just changed what your money does this year. There are new deductions, new write-offs, bigger refunds for a lot of people, and most folks are going to feel that extra cash hit their account and then watch it disappear. If that sounds like you, you're not behind. You're normal, but here's what nobody tells you. The law didn't just change your taxes. It changed the smartest move for every dollar you invest. And today, I'll show you exactly what to do next. Let me set the table for you. In July of 2025, a big federal tax package became law. You've probably heard it called the One Big Beautiful Bill. I'm not here for the politics of it. Not one word. I'm here for the practical questions sitting on your kitchen table. The rules changed, so what do you actually do with your money now? So here's the plan. We're walking through it the way you'd actually live it. First, the one mindset shift that matters most, then your paycheck, the new deductions hiding in it, then your investments, retirement accounts, then a brokerage account, then the house question, and we'll close with a simple playbook. Stay with me on this one because the mistake most people are about to make is in the very first part. Here's move number one. Stop letting a tax break decide what you buy. That was always shaky logic. After this law, it's worse because the headline numbers are designed to make you feel rich for a minute. Bigger standard deduction, new deductions for tips and overtime, a write-off for car loan interest. On paper, that's real money back. But a tax deduction is not a profit. It never was. A deduction just means the government taxes a little less of something you already spent or already earned. If you buy a car you don't need because the interest is now deductible, you didn't win, you just lost slower. So the test for every dollar changes. You don't ask, what does this cost me after my refund? You ask, does this move make sense even if the tax break disappeared tomorrow? Because a lot of these breaks are temporary, written to expire after 2028. If a decision only works because of a deduction with an expiration date, it's not a strong decision. And the math is right there. Now here's where it gets interesting. Before you invest a single dollar, look at your paycheck, because the law put money there first. If you work a tip job, there's a new deduction for qualified tip income, up to $25,000 a year. If you work overtime, the extra half in your time and a half pay can now be deducted, up to $12,500 if you're single, $25,000 if married filing jointly. Both of these phase out at higher incomes, and both are temporary, running 2025 through 2028. There's also a new deduction for interest on a car loan, but only on a new vehicle, financed, with final assembly in the United States, capped at $10,000 of interest a year. And if you're 65 or older, there's an extra $6,000 deduction, stacked on top of the standard one. Here's what this means for you in plain English. A lot of working Americans are going to see a bigger refund this year. That's real. But a refund is just your own money coming back late. The smart move isn't to spend it, it's to catch it before lifestyle creep does. I've been there. The year I finally got a real refund, I had it spent in my head before it landed. That's the trap. So the action here is boring and it works. Figure out what you'll get back and decide where it goes before it arrives. Let's talk about where that money should actually go. And we start with retirement accounts, because nothing the new law did changed the basic truth here. A 401k and an IRA are still the cleanest long-term tools most Americans have. If your employer matches part of your 401k contribution, that match is the closest thing to free money you will ever be offered. Capture it first, always. That's not opinion, that's the data. After the match, a Roth IRA deserves a hard look. You pay tax on the money now, going in, and qualified withdrawals in retirement come out tax-free. Think about what just happened. The new law generally kept tax rates steady. Nobody knows what rates look like in 30 years. A Roth lets you lock in today's rate and stop worrying about it. When the future is uncertain, paying a known tax now has real value. The catch with retirement accounts is the same as it's always been. Access. Money in a 401k or IRA is not money you can touch next year for a house down payment without penalties and headaches. So these are for the long game, Which brings up the obvious question, what about the money you might need sooner? But here's what nobody tells you about a regular taxable brokerage account. It's not a worse version of a retirement account, it's a different tool for a different job. A brokerage account has no contribution limit and no early withdrawal penalty. The trade-off is that when you sell an investment for a gain, that gain gets taxed. And here's the part most people miss. How long you held it changes the tax a lot. Sell something you've owned less than a year, and the gain is generally taxed like ordinary income. Hold it longer than a year, and it's usually taxed at the lower rate. The new law didn't blow that up. It mostly left capital gains alone. But it's a reminder of something that's always been true. Frequent trading is expensive and not just in fees. Every time you sell early, you can hand the IRS a bigger slice. A low turnover approach, a broad, diversified portfolio you leave alone, isn't just calmer, it's often more tax efficient. The tax code quietly rewards patience. Now, the house. A lot of people are wondering if the law changed the math. Here's the honest answer. The standard deduction got bigger and was made permanent. That's good for most people, but it also means fewer households get any extra tax benefit from a mortgage, because the mortgage interest deduction only helps if you itemize, and a bigger standard deduction means fewer people do. So the old story, buy a house for the tax break, is even weaker now than it used to be. Buy a house because the monthly number genuinely works for your life. Run it without pretending a deduction is part of your income. If the home only makes sense with a tax benefit attached, it doesn't really make sense. And if you're weighing the specifics of your own situation, that's a conversation for a CPA, not a YouTube video including this one. Here's the truth I want you to walk away with. The new tax law did not hand you a strategy. It handed you a slightly bigger pile of cash and a few moving parts with expiration dates. What it really did was reward the same boring habits that always worked. Don't chase deductions. Capture your employer match. Use a Roth while you know today's rate. Hold investments long enough to earn the lower tax. Buy a house on the real number, not the tax break number. None of that is new. The law just made the lazy, tax-driven version of investing look a little shinier and a little more tempting. Don't fall for the shine. So here's your one move this week. Pull out last year's pay stub and your loan statements and check whether you qualify for any of the new deductions, tips, overtime, or car loan interest. Then figure out roughly what you'll get back and decide right now where it goes. A Roth IRA or a high-yield savings account before that money ever touches your checking account. If this hit home for you, hit subscribe and turn on notifications. I drop new videos breaking down American money 3 to 4 times a week. Thanks for watching. Take care of your money this week, and I'll see you in the next one. Take care of your money.